All right, people are asking about MPI. I had to call Chris. I'm like, what's MPI?
Who is this guy?
And he's like, don't worry, we'll react to a video.
Yes.
Here we go.
Whole life insurance. Is it the best place for your hard-earned money? Based on my research, it's not likely. Whole life made sense 40 years ago due to high guarantees and unique benefits, but now I view it as an outdated, providing very little value compared to alternative life insurance contracts.
Ooh, can't wait to see these alternatives.
I know. I don't know if he's going to get into the alternatives here, but let's see what he has to say.
In the 1980s, whole life insurance might have paid up to 20% returns through dividends because of an unusually high interest rate environment.
Really?
20? That's
I don't know
no
that
way,
I've
man.
ever seen that. I think the highest dividend I ever saw was like 14.5%.
Yeah.
Like that's about the range. Late
Right.
80s,
And that's
14.5%.
gross, not net.
Yeah, totally.
So,
yeah.
Now the max dividend is typically below 6% before fees and cost of insurance.
Okay.
Why is it
True.
so low? Insurance contracts are typically built with security as focus and not growth potential. Because there's very little potential to produce good compound interest, to use these plans as your own bank or for retirement income make very little sense. However, some insurance agents push whole life onto the public as a good alternative due to high commissions and the ability for guaranteed.
Okay,
Whoa.
first off, let's really go. What he's selling is going to be the exact same commission structure.
But on products that pay higher percentages for commissions. So
Really?
Yeah, oh, for sure. So like think about it this way. So you go get a good contract. Well, let's just talk apples to apples. The top contract with any New York-based life insurance company is going to be 99%, and that's the top. If you're lucky to get 90%, if you're lucky, if you're a really high producer. With some of these other big companies that don't operate in New York, the top contract you're going to get is like 130, 135 at the most, and the top contract for IUL products is 165.
Really?
Yeah. So you're talking.
So
what
he's
yeah, like
just
it's
100% inaccurate in what he's
complete
saying
lie.
here.
And so what he's like at the end of the day, with all life insurance, whether it's IUL or whole life, there are different ways to design the policies, structure the policies,
Right.
and you can make them more commission based or less commission based.
And he's going to make it less commission based,
Yeah, I mean he's
as you could do with whole life.
Listen, I've seen a lot of MPI policies, and I've had a lot of people send them to me, and I'm stockpiling a bunch of them right now to interview clients of MPI and all that stuff, and it's really bad.
All right, let's see what it is.
Results, even if the results are below average. Let's compare the features and benefits, projected returns, and retirement income over a 30-year period between a whole life insurance policy and the MPI Secure Compound Interest Account, what I consider the IUL 2.0.
So IUL 2.0 on the MPI Secured Interest Account, just made up terms.
Secure Compound Interest Account.
Yeah.
Whole life is a permanent life insurance contract with many features and benefits similar to the MPI IUL 2.0 policy, but also some deficiencies when used as a retirement plan. Some of these features and benefits include guaranteed life insurance paid out to the beneficiary, living benefits, 100% tax-free distributions, liquidity with no access penalty of cash value at any age for any reason, and a guaranteed dividend typically around 3 to 4% minimum before expenses. MPI is an indexed universal.
Okay, first off, there's not a guaranteed dividend. That's just erroneous. There's a guaranteed interest rate and then a dividends on top of that.
Sure.
But
exactly. Yeah.
for just being accurate, that's all.
Yeah, totally.
The life insurance contract using increasing death benefit with many of the same features and benefits, but also enhancements to provide potentially much better retirement income. Some of the MPI features and benefits include guaranteed life insurance paid to the beneficiary, living benefits, 100% tax-free distributions, liquidity with no access penalty of cash value at any age for any reason, but rather than a low guaranteed dividend such as whole life, an MPI policy credits interest against the S&P 500 index.
Okay, so we might as well talk about the reality of this credits against the S&P 500 index and what's really going on there.
Yeah, so two
That's
things.
inaccurate.
First of all, guaranteed life insurance payout. If you look at the guarantees behind any IUL, you'll run the other direction. You're never going to put the money into it. And in fact, he's
it
talking
could
about
require much higher amounts of money than you originally contract for.
right. And so he's going to say, don't look at the guarantees. When they go to actually sell you, I promise you, they're going to be like, don't worry about the guarantees. But then he's going to pitch it here like it's a wild benefit, right? And then the credits interest against S&P 500 index. He made a comment earlier in the video that you can get returns greater than the S&P 500 when, in fact, I know for a fact MPI is utilizing Mutual of Omaha in most situations. Maybe they use other companies too, but it's predominantly
that are coming
Mutual
into
of
you.
Omaha. That's what's being
So
said
how does
to
their
me and shared
crediting
with me.
work?
So they have a cap rate. I don't know what it is currently. I think it's 10.5%. It was 10 last I saw.
So if the market goes above 10, you're not getting more.
You're not getting anything more. So if the S&P does more than that, you can't get credited greater than the S&P. And if you look at historical returns, the average of I don't even care about MPI. Okay, I care about what is this IUL
MPI is going to
doing?
be how you keep borrowing. We're going to get to what that
exactly.
is. Right?
It's strategy of how they're utilizing. It's the Index Universal Life chassis product, no matter what, is not going to perform better than the S&P 500 from a long-term perspective when you back everything out. And so you're basically what you're doing is you're taking a fixed crediting strategy. You put your money into the policy. A portion of that money goes to paying the premium or to the insurance costs, and a portion of it goes into like a cash value into the general fund of the life insurance company. They're going to create they're going to get a guaranteed return based on what their general fund does, and it's like the fixed crediting side of an IUL. And rather than give you that fixed crediting as a return, they're going to go risk it in options, and that's what they do. And so, the options budget, the options cost,
it's gonna be less.
No, yeah. I mean, that's if you understand anything about options, you understand that like this idea, this concept is never going to work long term.
Yeah.
Indexed with a guaranteed floor of 0% when the index loses value and a cap approximately around 10%, increasing your annual returns of 6 to 8% on average historically.
Okay, the problem with 8% is how many times would you have to get 8, 9, or 10 to average 8?
Mm-hmm.
If you have a 0, it was just like over like 4 years. What if you were 0, 0, 10, 10?
Right. He's saying 6 to 8. And so, right, if you go 0, 0, 10, 10, what is that? That's 20 divided by
like
4. It's 5%. Yeah. So, like, it's horrible.
And there's years that happens.
Yeah, for sure.
Right? Going like,
Consistent.
what if you did 2001, 2002, 2003, 2004? It'd be 0, 0, 10, 10.
Yeah.
2008, 2009, 0, 0, maybe 2010.
But
might have been
10, 10. Yeah,
Yeah.
maybe 8, 10, maybe something of that.
So this 8% average growth, and that's a big difference. 6% to 8% is 33% difference
Huge difference.
in your overall, right? Or
And
at
this
least,
is-
sorry, it's 25% difference.
And he's saying average growth. So he's not he got done saying before is like if you earn the 6% dividend in whole life, you got to back out fees and charges. You got to do that here too.
Right.
This is maybe 6 to 8%. If he wants to argue the 6 to 8% crediting to the policy in the last 10 years, I may defer
But again,
and
not
say,
apples
okay,
to apples.
Right,
Let's
exactly.
hear if he says back it out.
This method can increase returns over a whole life policy by taking advantage of the stock market growth potential and maintaining a 0% security feature.
So he's saying it's going to be that much bigger, but he's saying 6 to 8 here.
Mm-hmm.
And he was saying that back in the day, he said, oh, there was a time in the 80s where you get 20%.
Right.
Well, we're capped at 10 here.
Right. I tell you
I
what.
mean, which that 20% was mythical anyway.
I did a video the other day, and it's fascinating. I don't know how you feel about this, but like I did this video, and it has nothing to do with MPI. It has everything only in the context that MPI is using IUL. But think about this: moving forward, we're for the first time. If you really think about this, we're coming out of this decreasing and then flat interest rate environment.
Right.
So for the first time in 45 years, we're going into this increasing interest rate environment. And how you make money and what you have to do to be
different.
Completely different, right? And so when we look at
we're using all this strategy based upon what happened,
right,
not what is potentially going to happen.
So let's think about variables here, and I want to talk about this because it's super important, especially when we talk about strategies like the MPI, strategies like LERP, like we just did a review. When you look at that, we have to think about, okay, the problem with Index Universal Life in general is that there are too many variables. And when you understand the variables that go into what make an IUL successful, let's walk through this for a second. So the way I see it, and tell me what if I'm wrong, there's 3 different ways that we can go with interest rates. They can keep going up, they can remain flat, or they can go back down. Anything else? Pretty much it.
Yep.
Right? Okay, so that determines the options budget. Right? Because that's the fixed account. That's how the general funds are going to perform. So a lot of people say, all right, if the options budget goes up, then they're going to have more money. Typically, what happens in an options budget or in a market if rates are going up? Maybe, and we have seen a little bubble right here where cap rates have been increased in a couple companies. we're still in this really small window where, options cost because of market volatility and the economy is still doing okay. So rates have gone up, but there hasn't been a lot of volatility. So options costs haven't followed along suit. As soon as that does, that's going to negate the options or the options
less
budget,
money.
right? So there's going to be less money. But furthermore, eventually, and we've already seen it, at the time we're filming this, you just told me, I didn't even know, the market's been down 5% in 2 weeks, right?
Yep.
So I don't care if the cap rate goes up in an IUL, if the cap rate goes up, but because the cap rate's going up, because the interest rates are going up, that the index performance goes down, does it really matter? Because you're not getting anything.
Right.
You gotta have a 20% cap rate if the market's doing 2.
Right.
I don't care, right? It doesn't matter.
Yeah.
So no matter what, like IULs are kind of damned if you do, damned if you don't at this point in time moving forward. We just came through a greatest bull run of all time, and they kind of were bailed out by the market environment with low interest rates, good returns. Even though the cap rates kept getting reduced, the high performance in the market bailed them out. But the bottom line is moving forward, we have interest rates go up. If they stay flat, we have some problems, right? I think the market's going to struggle and performance of the S&P is going to be bad. The only thing that works in some way for IUL is if interest rates go down again, because it's gonna make it so the market and the S&P 500 performs better. But if the market goes down again, cap rates are going to come down because the options budget's going to go down.
Because of option budget.
So no matter what you do, but here's the deal.
That's why 8% is a daydream.
Yeah, exactly. And so, but when you look at whole life insurance comparatively, I would personally be willing to wager a fair amount of money that over the next 10 to 15 years, whole life actually apples to apples is going to way outperform any IUL policy because of the fact that if interest rates go up, whole life is going to capture that. IULs may have cap rates go up. I don't think they will. But what you're going to see is
dividend rates will go up.
Dividend rates are going to go up, and you'll be able to capture that in whole life. But even if you have the increased potential in IUL, the actual performance is going to be less because the market's going to suffer accordingly, right? So it's
So it's naive to say 6 to 8.
Sure, totally.
In addition, by accessing the participating insurance loan feature against the cash value at 4% currently.
Let's talk about participating.
Participating basically means...
So he's saying arbitraging it.
He's talking about arbitrage, right?
So he's basically saying, hey, participating, because you could still make more than what they're charging you when the market's going up and you get that spread.
That is the foundation of what MPI is built on, is the spread, the potential arbitrage. And if you know anything...
You're paying less for the loan than you're earning.
So got to get really technical to understand this, because there's illustration regulation that allows for IULs to illustrate 50 basis points or 0.5% of positive arbitrage. So if you borrowed $10,000 against a policy, they're going to charge you 5%, and maybe a little more, a little less. But if you pay 5%, it's going to illustrate it growing by 5.5%, right? So anytime you can do that on paper, obviously it's going to be amazing, right? It's going to be sexy.
You're going to have more money.
Yeah, it's going to be...
You're making money on someone else's money.
And it'll grow.
You're acting like banks do to your money.
Yeah, exactly. But it's not. It doesn't work that way.
Which we call the MPI RELOC, and contributing the additional capital back into the policy as increased premiums, the strategy can enhance growth potential up to 15%. Because an MPI life insurance policy offers interest credit against the index instead of contractual dividend, whole life could be considered a little bit more secure, as there may be years...
Could be. It's naive.
Years MPI receives no interest and still has basic expenses. But that little extra security in the form of a guaranteed low dividend can drastically impede your cash value growth and retirement distribution potential. Let's do the math. Consider a 35-year-old setting aside $10,000 a year into both the MPI and whole life contracts. After 30 years of growth, whole life is projected to have around $600,000 in cash value after a total contribution of $300,000. That is barely enough to keep up with basic inflation, providing minimal increased wealth. With an MPI with the same $300,000 contribution, the projected cash value is around 1.5.
Okay, I love it because projected, like fabricated. And it says MPI results calculated based upon a growth.
Based on a 6.4% growth and assumed 4% RELOC loan rate. So he's assuming, so let's talk about what this looks like. So at $10,000 annually, 30 years of growth, he's assuming you're using the RELOC feature, that it's 6.4% growth, that when you borrow against your policy for the RELOC feature, you're paying a 4% loan rate and earning 4.5% because that's how the illustrations work. So you're positive arbitraging that. That's assuming that for those 30 years,
you're always in a positive.
It's positive every single year.
But you probably have 40% of the time where it's not.
And I've done videos on this, not on MPI, but on retirement income utilizing IUL, which is very similar. The problem is that's when you start borrowing against IUL, that's when you inject all the risk into IUL.
Right.
And the problem with MPI and the RELOC is that you start doing that in year 3 of the policy. And so if you start doing that when you're 30, the problem is these loan rates compound against you. And when he's illustrating it being positive every single year, 10 years in, if you're young and the insurance costs are low and all that stuff, it might not be that bad. But the problem is now you have all these loan expenses that are compounding and compounding and compounding. And now you start hitting a couple negative years with this participating loan, index loan.
And this is assuming 6.4% to get to your 1.5.
Right.
I mean, so that's a big assumption.
But
and the arbitrage between here when you borrowed.
Here's what I want to say is that 1.5 million, I don't know the numbers, but I'm just going to venture to guess, and I'm going to ballpark it to say that if you have 1.5 million in cash value, at that point in time, you're going to have much more than that due in loan exposure.
Because you're borrowing
Because you're borrowing against it, and that's going to keep compounding at a compounding rate as well. So if you have
and you're buying a new policy every 4 years, 3 years?
I think it depends. I don't but at the same time, if you have $1 million of outstanding loans and the market does 0 1 year, not only do you have the insurance costs and all that stuff, but now you have an extra, if the loan rate is 4%, you have an extra $40,000 of expenses that are coming out of it. So when they say you can't lose,
you just lost 4%.
You just lost 4%, even if the market only did 0. Anytime that the S&P does less than the cost,
less than 4%,
less than 4%,
yeah.
you have a net
cost.
Extra expense that's getting injected.
And he's
into
assuming that's a positive every year. That is absurd.
It's completely insane.
That should be illegal to illustrate.
But more importantly, how much retirement income can he...
And how? There's no how here. It's just, I put 1.5 here and 600,000 there, making assumptions.
I told you you'd like this.
I kind of want to do a smooth video where I just draw numbers on a board and be like, which number do you like better?
Exactly.
Here you go. How about this, Kurt? You like that? Let's provide it.
Yep. And this is another guy.
This is Wizard of Oz.
This is another guy I've tried to get to debate me, and he lives right down the road, and he won't do it.
Yeah, I understand why. Look at this.
Whole Life, with their guaranteed dividend, will reliably generate around $30,000 of annual income, while MPI can produce up to 100.
So he's saying 10%. Can produce 10% of $150,000 of income. Show me anywhere in the world where that's happening.
Never.
That is insane. This is egregious, dude. Egregious.
I told you you'd love it. Here's the deal. I got for everybody. Do me a favor. Use common sense. If this were possible, all of the smart money in the world
would do this all day long.
There would be no other investing in anything else. If this were possible.
It's not possible.
$150,000 per year. A 250% projected increase in cash value.
Projected increase. Projected, that's projected with LSD.
Do you understand how he's doing it though? 250%.
Because he's saying
because of the RELOC feature. Because
the RELOC feature, because the arbitrage on the loan.
And just stacking ththose up. And when you do an extra 5% arbitrage on all these different loans over all the years, over the 30 years,
Where's that money going? Back in the policy? Borrowing and putting it back in, borrowing and putting it back in?
Yeah. What?
Like masturbation.
It's insane.
Jesus.
But most importantly, a 500% projected increase in...
500%. He's assuming 10%. Come on, people. There's people doing this. You will be disappointed. You're being taken advantage of because of not understanding actual economics and results. This should be illegal.
Increase in potential retirement income.
It will be.
All the while providing great security against stock market down.
Providing security with growth. Yeah, you just take 150 grand a year off of this account, assuming the market's doing 10% or greater every single year.
Not to mention, as soon as you start, let's just assume we're wrong, and he gets to retirement income, and he's got all this, and he starts pulling $150,000 a year out of this off the 1.5 million. What's gonna happen is now your loan exposure goes up. 1 or 2 negative years with all that loan exposure in retirement is going to completely derail the thing, and then you run into a person.
What's his name?
Curtis Ray.
Curtis, let me give you some advice. Number one, you need to move to Florida, bro. You need the Homestead Act. You need to have that home paid off so that when this implodes, you still have an asset left. Because you're going to jail, dude. This is crazy. And Mutual of Omaha, shame on you for allowing this to be promoted.
Yep.
This is crazy. This is reckless. It's
the worst thing
going
I've seen
to
in our
hurt
industry.
so many people's lives.
Yep. And there
so
are
many people's lives.
And he's got over 1 million followers on TikTok.
Market downturn and growth potential above the stock market. Some also use the whole life contract for a system called infinite banking or bank on yourself, which can produce even worse results than the whole life contract alone. Infinite banking might be the worst compound concept ever designed. I have another video breaking down infinite banking and just how bad it really is inside today's whole life contract.
That should be
and in my opinion, should never even be considered. You can find the infinite banking video next. The best retirement income potential means we must protect our money and find the maximum growth possible. Minimal risk might be required to achieve the retirement you expect. Therefore, whole life, with the guaranteed dividend, may likely leave you with an underwhelming and frustrating end result.
There you have it.
I have nothing to say, man. Like,
I told you, it's the most
if you're looking at
atrocious
this for your life, come on. Like, is the market going to do 10% every year when you're in distribution?
Think about
Is
it.
it going to get over 8% or more when it's capped at 10? Like, if you get a 3, a 5, a 7, a 10, a 10, like even in those numbers with no down, with no 0%, and then you're showing a 6.4 against a 4% as always a positive arbitrage spread. Here's why that looks so good.
Yeah.
If I could buy a hammer for $4 and sell it for $6.50, what's that markup? It's like what, 40% markup?
Yeah,
that's a
something like
40% return that he's showing
it's
on
better than that.
arbitrage,
60%,
right? It's 60% return. So of course it's going to look amazing. It's fabricated bullshit. It's unicorns and fucking rainbows that don't exist in anywhere but fairy tale land. And this young kid that looks so uneducated on this is going to destroy lives, including his own, unless he starts to look at real numbers and reality. Do not listen to this. It's garbage. It is going to destroy your life.
I'm glad I found somebody who's fired up about this.
Dude, it's because it's real people
I know.
that are going to have this life
thousands and
that,
thousands of
that they think will exist. And here's the damage that isn't being talked about. When people think they're going to have a massive amount of wealth in the future, you know how they spend today?
irresponsibly.
Exactly. It's called spending optimism. Look, man, we used to have this movement called the producer revolution. And we'd be like, are you a producer?
Yeah.
Right? And the notion was you produce more than you consume.
Sure.
But it was at a time where there's massive equity in people's homes.
Yeah.
And they pull that equity out and they put it in hard money lending and they get 1% a month, 2% a month, 3% a month, 4% a month, 5% a month. It's
great until it's
not
not.
sustainable.
Yeah.
They're buying crazy vehicles. They're driving around in these vehicles. They're buying homes they can't afford. They're living this life beyond their means because they expect that to be a gravy train that
Forever.
continues. And I watch people get substantially hurt. I watch people go to jail. I watch lives ruined, marriages lost. That's the kind of stuff this does.
And I don't know if I have no insight into like his policies and like what he writes, but from the comments,
from
the comments that I see on TikTok and YouTube and Instagram and all that stuff on his channels, even though he's blocked me on TikTok and Instagram now for obvious reasons, the people that are attracted to this message from what I've seen are the people that can afford $300 a month, $500 a month. Like it's everything they got, but it's appealing if
because they're trying to hack their way through and dude, I keep having-
so I mean the idea if you have very little,
this is snake oil.
if you have very little and like you can squeak out $500 a month, but you believe that $500 a month is going to solve your problems, even though it's not, it's putting you in a worse situation.
It's hope without reality.
Yeah.
And it's going to hurt people massively.
Yeah.
So,
All right.
yeah.
There you
Sorry.
have it.
Sorry to be the bearer of bad news, but hopefully you can take a different course, reclaim control of your life, cut through the bullshit, and have a much better situation.